The United States is planning to destroy the monopoly of OPEC Plus countries over the global oil market. In the last few years, the United States has become the biggest producer of oil in the world, which helped the country and its allies decrease their reliance on oil imports from the Middle East and Russia, and mitigate efforts of OPEC Plus countries to artificially boost oil prices. Right now, the United States is expanding its export capacity to capture the market share from the OPEC Plus countries and destroy their monopoly over the oil market. It took more than half a century for the United States to get to this point, but it has all the tools and opportunities right now to finally force the powerful oil cartel to lose its influence across the globe. The desire of the United States to break the OPEC Plus monopoly over the oil market takes its roots in a post-war period, when America expanded its influence in the Middle East after the biggest oil fields were discovered in the region. In 1951, the United States signed a mutual defense assistance agreement with Saudi Arabia, under which it provided American weapons and military training in exchange for oil concessions and oil imports. In 1953, the United States installed a friendly government in Iran and helped the American oil companies expand there as well. In 1960, Iran, Iraq, Kuwait, Saudi Arabia and Venezuela, which at that time were responsible for a third of global oil production and were slowly nationalizing domestic oil assets owned by multinational companies, created OPEC, which is short for the Organization of the Petroleum Exporting Countries. Their goal was to set a common energy policy to try and artificially increase the prices of oil. It was done by coordinating the decrease of oil production on their territories, which resulted in the decrease of oil supply on the global market and made the oil more expensive to buy. By 1973, Qatar, United Arab Emirates, Nigeria, Libya, Algeria, Ecuador and Indonesia had also joined OPEC to benefit from the common energy policy and increase their oil profits at the expense of importers from the Europe and North America. In September of 1973, OPEC countries began to leverage their dominant position over the global oil market by imposing an oil embargo on the United States and its allies as a response to Washington's decision to provide a military aid package to Israel so that it could repel the invasion of Egypt and Syria onto its territory. The embargo has resulted in oil shortages in the Western world and increased gasoline prices in the United States by as much as 40% in the matter of months. While in 1974 the OPEC embargo ended after the United States brokered a ceasefire between Israel and Egypt, the policymakers in Washington understood the importance of energy independence, since they could no longer fully rely on its partners from the Middle East. In 1975, the United States established a strategic petroleum reserve, which is an emergency stockpile of oil located in underground tanks in Louisiana and Texas that can be used to mitigate supply disruptions of oil. But it was not enough to fully decrease reliance on Middle Eastern oil, since the domestic production of oil in the United States at that time has stagnated. That is why the United States continued to rely on oil imports in the following decades and has been experiencing shortages from time to time. In 1979, the revolution in Iran resulted in the overthrowing of the Iranian monarchy, led to the decrease of oil production in the country, ended oil exports to the United States, and prompted global oil prices to more than double. In 1980, Iran and Iraq went to war with each other, which led to the removal of millions of barrels of oil production from the global oil market, and prompted the United States to increase its military presence in the Middle East to protect the oil facilities and shipments of its remaining allies there. In 1990, after Iraq invaded Kuwait, the United States led a multinational coalition to liberate Kuwait a year later, as America at that time imported half of the oil it consumed, primarily from the Middle East. In 2003, in the aftermath of 9/11, the United States and its allies invaded Iraq to depose the regime of Saddam Hussein and secure the oil fields of Iraq. All this time, the United States has been highly reliant on oil imports from OPEC countries, which is one of the reasons why the country for decades has been actively involved in regional affairs in the Middle East. But soon, everything began to change. Ever since 1985, the American oil production has been declining. If in 1985 the United States produced 8.9 million barrels of oil per day, then by 2008 it was producing only 5 million barrels per day. At that time, American oil producers began to mass adopt a technique called hydraulic fracking, which enables the extraction of oil from the shale rock formations with the help of horizontal drilling. Thanks to having access to cheap capital and knowing well the American geological conditions, the oil companies such as ExxonMobil, Chevron, and others expanded their operations primarily in the Permian Basin that is located in Texas and New Mexico. With the help of fracking, they were able to fairly quickly scale the production of oil in the United States. By 2015, the United States was producing 9.4 million barrels of oil per day, an increase of 88% from 2008. At the same time, in 2015, the country imported only 2.7 million barrels of oil per day, down from 3.6 million barrels of oil per day in 2008. In 2015, the United States also repealed a 40-year-old ban on oil exports, which transformed the country from a major customer of OPEC countries to their direct competitor in a matter of years. The entrance of American oil into the global market started to pose a major threat to OPEC. In 2014, OPEC tried to drive the American oil producers out of the business by launching a price war and temporarily flooding the market with oil, which plummeted the oil prices and made it less attractive for some frackers to continue to produce oil in the Permian Basin. The price war lasted until 2016, and the average price of Brent crude oil during that year was $45 per barrel. But that did not stop the major companies from abandoning their projects in North America, as they managed to decrease their operational costs and adapt to the new environment. This forced OPEC to look for an alternative strategy. In late 2016, OPEC countries made a deal with major non-OPEC oil producers like Russia, Kazakhstan, Mexico, and others to coordinate their response to the fracking revolution that diminished their influence over the global oil market and created a format called OPEC+. As of today, OPEC+ consists of 12 OPEC countries and 11 non-OPEC countries that together coordinate their energy policy. Since its inception almost a decade ago, OPEC Plus has been constantly decreasing their production of oil to keep the oil prices relatively high. This has been hurting American consumers, since the United States still imports some portion of the oil from the global market and is also the biggest consumer of oil in the world. So while fracking helped the United States mitigate some of the OPEC Plus risks, the country's biggest challenge was about to begin. The Russian full-scale invasion of Ukraine in 2022 disrupted the global energy markets and resulted in a major appreciation of oil prices to over $120 per barrel of Brent crude oil. Russia was the third biggest producer of oil in the world at that time, so the impact on the market was significant. In response to the Russian invasion, the European Union, which relied on oil imports from Russia in the past, imposed sanctions against the Russian oil, which continue to be in place to this day. While the decision of the European Union significantly diminished Russian market share in Europe, Moscow managed to increase exports to China and India, which are currently the biggest buyers of its oil and are partially responsible for financing the Russian war efforts against Ukraine. To mitigate the price shock that happened as a result of the invasion, the United States wanted to make a deal with its ally Saudi Arabia, under which some OPEC Plus countries would announce the increase of oil production on their territories, which would have eased the pressure on the oil market and made oil cheaper to buy. But the opposite happened. In October 2022, OPEC Plus countries agreed to decrease their oil output by 2 million barrels per day, which accounted for around 2% of the global daily oil consumption at that time. The idea was to keep the oil prices high and help OPEC Plus countries, which rely on oil exports, to sustain their economic growth, generate record profits in a short amount of time at the expense of the Western countries. This has angered the United States, which began to work on a comprehensive plan to destroy the influence of OPEC Plus over the global oil market. Throughout 2022 and 2023, the United States has been releasing its oil from the Strategic Petroleum Reserve, which eased the pressure on the oil market. At the same time, the United States continued to extract more oil and in 2024 reached a new record of producing 13.4 million barrels of oil per day. Thanks to this, the United States now produces more oil than any country ever. American companies such as ExxonMobil and Chevron have also expanded their presence in Guyana in recent years after oil was discovered there. By 2027, Guyana alone could produce as much as 1.5 million barrels of oil per day, which is almost as much as OPEC Plus took out from the market in 2022. After Venezuela decided to vote on the referendum to annex part of Guyana last year, the United States sent its advisors to Guyana and has been increasing its military aid to the country to protect protect its interests there. Other American allies such as Canada and Norway have also been increasing their oil production recently. In the last year, the United States and Norway even replaced Russia and became the first and second single biggest exporter of oil to the European Union, thanks to the ability of the United States to scale the production of oil and work with its allies to increase their production as well. The Western countries now slowly decreasing the influence of the oil cartel of the global market. In 2022, OPEC countries produced an average of 32.9 million barrels of liquid fuels per day, while non-OPEC countries produced an average of 67.1 million barrels of liquid fuels per day. In 2023, the production of OPEC countries decreased to 32.2 million barrels per day, while non-OPEC production increased to 69.6 million barrels per day. In 2024, OPEC production is expected to decrease once more to 32 million barrels per day, while non-OPEC production is forecasted to rise to 70.4 million barrels per day. Despite the constant production cuts by OPEC+, the increase in non-OPEC supply pushed the oil prices lower since 2022, and countries like the United States have also started to capture the market share of OPEC+ countries, which are artificially decreasing their production. This has already led to disagreements on what policy to pursue within OPEC+. At the end of 2023, Angola left OPEC saying that it gains nothing from decreasing its oil production. Although Brazil joined OPEC+ at the beginning of 2024, it has done so on the condition that it won't cut its own production, as the country aims to become one of the 5 biggest producers of oil by 2030. There are even reports that the United Arab Emirates disagrees with Saudi Arabia on production cuts and was threatening to leave OPEC last year. There is also proof that Russia is not honoring its part of the deal and is not cutting production, which has been irritating Saudi Arabia in recent months. This is why OPEC+ faces a dilemma. If it continues to stick with its current policy of production cuts, then it risks losing even more market share to other countries like the United States. If it decides to cut production even more, then its members are likely to face even bigger budget deficits and economic disaster. While Saudi Arabia announced that it plans to increase oil production in the next few months, there is also no guarantee that it will be able to quickly win back the lost market share. That is why no matter what OPEC+ decides to do, the United States already looks like a winner, since it will continue to capture a greater share of the global oil market, as there is no indication that its production of oil will slow down anytime soon. While it took more than half a century for the United States to get to this point, it is now in a position to finally force the powerful oil cartel to lose its influence across the globe once and for all.